Thank you. Thank you.
Thank you. I'm Ryder Meehan. With me, as always, my co-host, Chris.
Hi, I'm Chris van der Vaart. I am a full-time investor, and Ryder and I have been doing this meetup for how long now?
It's been about 2 years.
Yep.
2 years strong. So thanks first off for everybody coming. Thank you to our generous hosts. This is Anchor Co-working. If you're looking for a co-working space, I highly recommend it. My office is here. Meehan Digital. We're a digital marketing agency. I'm also an investor, so I have about 12 rentals, self-storage facility. I'm invested in syndication. I've done a number of flips and wholesaling. So a little bit of everything.
And there's a private lending, of course.
Oh, yes,
that
of
we
course.
both do. Yep.
Yeah. Also our other host, Entrust, who is Bill Neville, the speaker tonight, is covering our video. So if you ever miss an event, we try to post some the next day. So like within 24 hours, you can catch some at vigsf.com/videos or on our YouTube channel. Our other sponsor is Topstone Investments. So if you're looking for a turnkey provider or a more passive investment, Topstone is one we highly recommend.
Yeah.
I know, Chris, you've invested with them a number of times.
I do quite a bit of private lending with them, and that's one of the things I'd recommend them for. If you're looking to do private lending and you're interested in getting some good returns on some shorter term stuff, I'd be very happy to tell you what my experience has been. And it's obviously been pretty good, because that's one of the reasons why we allow them to sponsor our drinks and pizzas.
Cool. So, did you want to?
I want to go over the house rules real quick.
Right.
So, as Ryder said, this is the co-working space. It's called Anchor Co-working. We're guests here, so please clean up after yourself. Restrooms are around the back over there. Trash bins over there, and I think there's another one over there. And please stay in this area. There's I think about 200 people that run their business out of here. And please stay in this area as far as like the water cooler there and here. Ryder already pointed out Topstone, or sponsor. Then I want to go over the agenda real quick. Bill Neville from the Entrust Group is going to give us his 1-hour presentation about the investing from your self-directed retirement fund. After that, we're going to give the mic to all of you so you can start getting ready for that. However, we expect you to keep it to about 20 seconds or so, where you explain who you are, why you're here, and what it is that you have to offer or what you're looking for. So that's your time. That's one of a lot of people's favorite parts, the member introductions. And after that, we kick it off for another 30 minutes or so of networking right here. And after that, there's more networking at a bar right down the street. If there's people that they really want to finish their thought or just get a drink. So that is the agenda. So then I want to give it to Ryder for a couple of household items and to introduce Bill.
Yeah, so our speaker, well, first off, I want to announce we're working with a charity now, Kiva, doing some exciting stuff. I think we bought a goat.
I think we bought some sheep, and then we invested in a used shoe business in Nigeria, I think. Yes, it's basically sometimes we charge for our meetup to make sure that people actually show up, and that money is because we don't do this to make money off the meetup. So we decided to run that through our Kiva account. Kiva is basically, it allows you to lend to people that are in countries where it's kind of hard to get loans. You don't get any interest on it. It's a charitable thing, but you do get your money back if all works out and the goat, yields, I guess. So so that's what we're doing. There's links to that on our website, vigsf.com, if you're interested in that. And we do encourage you to, also give back a little there.
Yep. So another big part of our group is our survey. So it helps us understand our members, helps us bring relevant content to you guys. And occasionally we'll do kind of a group invest when we find a really exciting project. We'll try to get a group of our members together to kind of all go in on it together because, you know, you can way more purchasing power, combine networks. It's just a better way to do it. So if you want to be a part of that, if you ever want to see what kind of investments we're kind of pulling together, or just get knowledge from our email list, go to vigsf.com/survey and fill that out. It takes about 1 or 2 minutes, and it helps us a lot, and it helps us bring you good stuff. The last thing is our speaker.
Except for the YouTube channel?
Except for our YouTube channel. So you can either watch it on vigsf.com/videos, or you can go to VIG on YouTube. So I think you just have to Google Virtual Investors Group on YouTube and you'll find us. All right. So Bill Neville, I've known him for a couple of years. He's very popular in the meetup circuit. I've opened my self-directed 401k with him, as well as Chris through Entrust Group. They have an excellent reputation. I know a dozen people that have opened accounts with them. If you're not familiar with the concept of 401k self-directed, he has a lot of information. He makes it like very easy to understand how it works, and he makes it pretty easy to open the account and invest with it. So I think it's a very powerful tool. If you ever feel like, oh, I don't have the funds to invest, but you do know that you're late in your career maybe, and you've been saving for your self-retirement account, and you're watching your mutual fund get a couple % a year, and you'd rather be opening an account with like Topstone and getting double-digit passive returns, or a syndication or whatever, you do your own project. Lots of options. So Bill will break this down. So without further ado, our live studio audience, hit the applause light. Thank you, Bill.
Thanks.
Bill Neville.
Thanks, guys. Yeah, I want to talk a little bit about my history with Ryder and Chris. So I met Ryder at another meetup. Jay, I forget Jay's last name. Anyway, it was his meetup. Jay Martin. Afterwards, there was networking at a bar, and Ryder and I got to chatting, and I told him about what I did, and I think he opened an account about a week later. And at the time, Ryder had started this meetup, and he was holding it at Chinatown at the public library. And the first meetup that I went to of his group, and he had just started it, there was maybe 10 people that were there, and there was no presenter. It was just like, I don't really know, like, well, I just thought we would talk about real estate investing, basically. And I remember Chris was there, and we just chatted a lot. And then a couple, maybe the next month or a couple months after that, he had me come in and do a presentation. And then last year, so that was a couple years ago, last year I came back and I did the last presentation at Chinatown before he moved it up to the Mission. He was holding it up at a realtor office up there, and had probably about 40 people. There were more people than are here tonight, but it was also, I don't think, quite as nice of a evening as it is. I think that might have kept the crowd down a little bit here. And then next thing I know, I'm seeing up at the Mission, he's got 70, 80 people there, and this all happened in a couple of years, and so kind of got to see that growth. And so I appreciate being able to grow along with it. I was hoping you had 100 people RSVP for this, so either it was too nice or they realized what I was going to be talking about and decided it wasn't that interesting to them. But I appreciate you guys all being here. And so what we're going to do is, this is top 10 questions. So we're going to talk about, I'm going to take you through self-directed IRAs through questions that we typically get. And this is going to be a little bit interactive, so I'm going to be asking for input and feedback on this. So first of all, I'm legally required to put this up. So Entrust Group, we provide administrative and custodial services for retirement accounts. We do not provide advice or sell any investments or recommend any particular investments. We purely provide the administrative and custodial services for what are called self-directed retirement accounts. And by the end of this, you'll have a much better understanding of what that means. But I'm not a lawyer or a CPA. I don't give advice. I don't give tax advice or anything like that, although I know some stuff about it. And feel free, as we're going along, to ask questions. Although probably the question will get answered throughout the presentation if you wait. So a little bit about us. We've been in business for over 35 years. We hold about $3 billion in assets. We're headquartered in Oakland, and this is the main thing. We are the leading educators in our industry. We are the only company in our space who has a national continuing education program that we have a class. I just gave one a couple days ago to realtors, which provides 2C credits, and we also have one for CPAs that give 2C. It's a 2-hour class. And we focus on education. So what I'm going to be talking about today, I'm strictly going to explain to you how you can invest in alternative assets inside your retirement account. I'm not suggesting that you should. I'm not going to try and convince you that you should. I'm just simply going to explain how it works, and you guys can decide for yourself if that's something that you want to do. So the number one question we get, what is a self-directed IRA? So I'm going to see if anybody has any thoughts on what it might be. I'm going to give you a hint. There's 2 criteria that a retirement account needs to be considered self-directed. Does anybody have any thoughts on what it might be? One of them's in the name, self-directed. You make your own investment decisions, right? You don't have anybody from Entrust who's advising you or suggesting what you're going to invest in. So that's criteria number 1. Criteria number 2, anybody have any thoughts? You're allowed to hold alternative assets. You're allowed to invest in non-traditional assets. So most people who have a retirement account is invested in stocks, bonds, and mutual funds. You have your account with a Fidelity or Charles Schwab or one of those companies, a brokerage firm or a bank, and those companies only are willing to let you invest in stocks, bonds, mutual funds. Most people who have a 401k with a company, they have it's administered by Charles Schwab or one of those companies, and they give you a list of mutual funds, and they say, if you're this age, we recommend these funds, or if you have this risk tolerance, we recommend these funds, and and you might have a broker or somebody from that company that you talk to, and they might ask you what your risk tolerance is, what you're invested in, and then they'll recommend some mutual funds to you. But if you went to them and said, I'd really like to invest in this rental property over there, they'd be like, we don't do that. It's not that you're not allowed to do it. You're allowed to do it. The IRS allows you. It's just that those firms are not willing to hold other assets besides stocks, bonds, and mutual funds inside a retirement account. So you literally can invest in pretty much anything you want inside a retirement account. And I'll get into what you're not allowed to invest in. But real estate, precious metals, private placements, promissory notes, tax liens, trust deeds. We had somebody invest in a racehorse. We had somebody invest in cattle. I had a call a couple weeks ago that I told the guy I was going to add this to my list of sort of different investments that people do, that he wanted to use his retirement account, money from his IRA to fund a friend of his, the person that he knows, who's trying to become a Formula One race car driver. And so he was asking, can he use his IRA to invest in this individual as a race car driver? And then obviously if he's successful, it would pay back to his IRA. And I said, yes, that's an investment that you're allowed to do inside your retirement account. You just have to have your account with a custodian who's willing to hold that type of asset inside the account. That's where Entrust comes in. We are a custodian willing to hold those types of assets. So you're not locked into the limited types of investments that brokerage firms limit you to. Stocks, bonds, mutual funds, the real estate, or the Wall Street assets, right? You're allowed to invest in other things. And then lastly, in order for an account to qualify as a retirement account, for it to exist as a retirement account, it has to be held by a third-party custodian. That's a rule for retirement accounts. So again, that's where Entrust comes in. If you want to use your IRA or your 401k, or even a health savings account or educational savings account, if you have those, you can self-direct those into other non-traditional assets. So every once in a while, you might see like a Schwab might advertise and say that you can have a self-directed IRA with them. And what they're talking about is that you pick your own stocks, right? Like you can open an account with them and then you can just trade in your own stocks. But that's not a true self-directed IRA because it doesn't meet one of the criteria in that you can't hold non-traditional assets. And again, non-traditional asset is anything that's not a publicly traded stock, bond, mutual fund. I use that as a very global term for everything else. There's a whole world of investment opportunities out there. And so all IRAs, including self-directed, fall under the same rules in terms of contribution limits. So a self-directed IRA is not actually a type of IRA. It's an industry term that means that you take your IRA, be it a traditional Roth, SEP, simple 401k, or a health savings account or educational savings account, and self-direct it into whatever you want. But it's still, the contribution limits are the same. The tax rules are the same in that it's either tax deferred and it's pre-tax and grows tax deferred, or post-tax grows tax free. And I'll get into explaining exactly what those are. And so there's a term that you might hear which is called real estate IRAs. And what's a real estate IRA? It's an IRA that invests in real estate. So just like self-directed IRA is not an actual type of IRA, it's just a marketing term that, again, means you can make your own investments and hold alternative assets. A real estate IRA is just a marketing term that promotes the idea of investing in real estate inside your retirement account. So if you ever run across the term real estate IRA, you decide you want to have one of those accounts, and you go to open an account and you don't see real estate IRA is listed as one of the type of accounts. It's because it's not a type of account. It just means that you can, did I lose that? Okay. You can invest in real estate. So an IRA that invests in real estate, standard IRAs rules apply to all IRAs. Any kind of real estate is eligible to be invested. You can invest in commercial, in single-family homes, in multifamily, in land, in offshore real estate. If any kind of real estate is allowed to be invested inside your retirement account. There are some rules around it that we're going to get into as far as what real estate you can invest in and what you can use. So the types of IRAs: traditional IRA, Roth IRA, if you're individual, so any individual with earned income can open one of these accounts and contribute to it. And then if you're an independent contractor, you have a business, you can do a SEP, a simple, or we have an individual 401k. That means it's for business owners, their partners, business partners, and their spouses. So our 401k is not eligible for people who have employees. So just real quickly, so that everybody, I'm not going to assume anybody knows what these are. So traditional, SEP, simple, and individual 401ks, you will contribute pre-tax. So when you make a contribution, you get a tax deduction. You lower your taxable income for that year for the contribution that you make, but it grows tax deferred, which means at some point when you take a distribution, you have to pay taxes on the withdrawal. You have to pay tax on the distribution. Most people who have retirement accounts have a 401k because they started with a company and the company provided a 401k and they put some money in and the company matched it and they have it with a brokerage firm and they put it in stocks, bonds, and mutual funds. But at some point, you may leave that company, right? Or probably are going to leave that company. When you leave that company, you're now free to do what you want with that 401k. The majority of our account holders who open accounts with us at one time had a 401k and they grew it and now they want to invest in real estate or something else and they roll over the money from the 401k into an IRA with us and that's how they get the money. A Roth IRA is post-tax contribution that grows tax-free. So you don't get a tax deduction when you make the contribution, but all the earnings are completely tax-free as long as you're at least 59.5 and you have a Roth account for at least 5 years. So if you meet those two qualifications and you take a withdrawal from a Roth IRA, you don't have to pay any tax on the earnings. It grows tax-free. But you don't get a tax deduction when you make the contribution, right? So when somebody opens an account with us and they want to invest in real estate or with Topstone or a syndication or whatever it is, or a race car driver, they have to choose a type of account that they want to open. So they're going to choose a traditional Roth, SEP, simple, 401k. And the number of people that I get who won't open an account and they'll call me and say, I don't see self-directed as an option, is because self-directed is not a type of account. Okay, I just want to be, I think I've been clear on that. So that's the types of retirement accounts. Anybody have any questions on traditional Roth, SEP, simple, 401k? Contributions, yeah. Sure. If you have you have your own company, you can have a 401k. What was the last part of the question? Oh, it's a good question. So 401k has a Roth option. So that's it. So IRAs and 401ks fall under different areas of the tax code. So 401ks have a little more flexibility than IRAs. The difference between the personal, traditional, and a Roth and the SEP, simple, and the 401ks is the contribution limits. Traditional Roth IRAs, you can only contribute $5,500 a year unless you're 50 or older, then you can do an additional $1,000. With a SEP, in an individual 401k, you can contribute up to $55,000. Okay, with a SEP, you can contribute 25% of your income, maximum $55,000. With an individual 401k, you can contribute $18,500 as the employee. You can also contribute an additional amount as the employer, because when you're self-employed, you are both the employee and the employer. Okay, so that's the main difference between individual retirement accounts, the individual personal ones, traditional Roth, and the business ones is the contribution limits. But all of those can be self-directed. And then again, our individual 401, it's an individual 401k, but yes, there is a Roth option, what's called a Roth option in 401ks that allows you to contribute post-tax into a 401k.
When you take the distributions from the standard IRAs, not the Roths, are you just, is that money just bundled into your annual income, then you pay whatever tax bracket you landed?
Correct, yeah. So he asked, when you take a distribution from a non-Roth, any of the other ones, how's the tax calculated? Yeah, it's income. It gets added to whatever you earned or didn't earn that year, and then it just gets taxed to whatever tax bracket you fall in. So we would send you, the company that you take a distribution from will report what they distribute to you on a 1099. You get a 1099, the IRS gets 1099, you report it on your income tax. And you can have the company withhold tax whenever you take a distribution. Like typically, you can automatically withhold, they'll withhold 20% unless you, in our case, we'll withhold 20% unless you tell us you don't want us to, right? So we're basically paying the tax for you, yeah. Well, yeah, okay, good question. So, right, so let's talk about that. That's a good question. So with retirement accounts, with traditional SEP, simple 401ks, you, prior to 59, so you can take a distribution from a retirement account anytime you want. You don't have to wait until you're a certain age to take money from your retirement account. But it's suggested that you wait until at least 59 and a half, because along with the tax that you're going to pay, there's also a 10% penalty prior to 59 and a half. 59 and a half to 70 and a half, there's no penalty. You still get taxed. You're always going to get taxed. At age 70 and a half, they have what's called required minimum distribution. You have to start taking distributions from your retirement account when you hit age 70 and a half. Roth IRA has no required minimum distribution, but you have to be over 59 and a half in order to take a distribution and not pay any tax on the earnings. You can take your contribution out because you made your contribution post-tax. You can take that out anytime you want, but if you want to avoid tax on the earnings, you have to be over 59 and a half.
And are they considered assets where you can leave them to next of kin as well?
Yeah, you name a beneficiary. Yeah, a retirement account, you name a beneficiary in the event of your death, right? So you're actually the beneficiary of the account, right? So when you open a retirement account is held by a custodian, beneficiary of the account, right? But then you name a beneficiary in the event of your death. So if you die, then the whole entire account passes to whoever you name as the beneficiary, the one or two, or some people name trusts. Family trust is the beneficiary. Okay, so now we got the, boring part out of the way. So last part, what is a self-directed IRA? So here's the only things you're not allowed to invest inside a retirement account. So I mentioned you can invest in almost anything, virtually anything. These are the only things you can't: collectibles, life insurance, and S corporations. So collectible, works of art, alcoholic beverages, coin collections. So there is a difference between coin collections and precious metals. So you can invest in gold, silver, platinum, palladium. There are dealers that sell investment grade metals, which is different than buying coin collections, right? And it's based on the purity or the fineness of the metal. So, and like as an example, it says alcoholic beverages. So you can't hold wine inside your retirement account, but you could invest in a winery, right? Because one's a business, the other one's a collectible, all right? Can't hold art, but you could invest in an art dealership, okay? Collectibles, life insurance, S corporations, the only thing you're not allowed. Other than that, as long as it's for investment purposes, you're allowed to invest inside your retirement account. Okay, what are the advantages of self-directed IRA? Anybody have any thoughts on any advantages you see? They get the tax advantages, right? If you buy real estate inside your retirement account, you don't, when you sell it, you don't have to pay capital gains tax, right? So that's a general advantage of IRAs in general, is you get the tax advantages. Specifically, self-directed IRAs is you get to, first of all, make your own investment decisions. You don't have a broker who's saying, wow, these funds are great. And by the way, next year I'm going to ask you to buy more funds so that switch these out so I can get a commission on it, right? If you're here, I'm assuming you go to meetups to learn about real estate investing. It's something you're considering. Well, you can do it inside your retirement account if you want to, right? I mean, if you know more about real estate than you know about the stock market, it might only make sense that you would at least consider investing your retirement account in real estate. Okay, so you get to invest in things that you know and understand. This guy that called me, he's got a friend who he thinks is going to be a successful race car driver. He thinks it's a solid investment to make inside his retirement account. Who might have said it's not a good investment? Okay, the big one, you get to diversify. You're not just limited to stocks, bonds, mutual funds. Most people with their retirement account, they have it with a brokerage firm. They have some broker who recommends these 3 or 4 different funds and says, look, here's a small cap fund, and here's an international fund, and here's a tech fund, and look how great you're diversified, except 90% of it's in the stock market. And when the stock market goes up, they all go up. When the stock market goes down, they all go down. But somebody holds money and holds part of their retirement account in gold, and the stock market goes down, what typically happens? Gold typically goes up. You hold money in real estate, and the stock market goes up or down. Does real estate go up or down in the same direction? Maybe, maybe not. But it's diversified, right? Instead of just having 3 or 4 different funds that a broker says, and by the way, it may sound like I'm being critical of like investing in the stock market, and I'm not. People have made a lot of money in the stock market, but I just don't know that it's really well diversified, okay? And then lastly, you get the tax benefits of it, right? So when you contribute, the earnings grow either tax deferred or tax free, depending upon the type of retirement account that you have. All right. If your IRA invests in a property, yeah. I'm sorry. Yes. So you can't, if you're contributing to a 401k, then you're considered covered by that 401k, so you can't contribute pre-tax to an IRA as well. If you're talking purely about contribution, right? If you work for a company that you contribute to that 401k plan, and you also want to contribute to your own IRA, the IRS doesn't allow you to make a pre-tax contribution to that IRA because the term is you're covered by the 401k plan. Now you can contribute to a Roth, even if you're covered by a 401k plan, or you can make a post-tax contribution to your traditional IRA, which is, you might as well just contribute to a Roth if you can do that. But if you have an IRA and you also have a 401k that you're covered by, like that IRA is an IRA. Whatever earnings it has is still going to grow tax deferred or tax free because you already put the money in there, right? It already exists in there. So we have a lot of people who have IRAs with us, and they also have an IRA with Fidelity, or they have a 401k with some company that they work for. You're not limited to only having retirement accounts with one custodian. You can have multiple different retirement accounts with different custodians. A lot of our account holders open accounts with us and do a partial rollover, partial transfer, just the amount of money that they want to put in to the race car driver, right? But they still have an account with Fidelity or whoever that they've got invested in the stock market, and that's absolutely allowed. And they're all retirement accounts, so they all still grow tax deferred or tax free depending upon the type. But contribution-wise, if you're working for a company that either you're or the company is contributing to that 401k plan, you can't do your own contribution, at least not get the tax benefit by contributing to your own IRA. You can contribute to a Roth, like I said. Did that answer your question? Okay. If your IRA invests in a property, can you stay in that property? Yes or no? No? Anybody say yes? Absolutely not. So if you are using your retirement account to invest in anything, in an asset, it has to be for investment purpose only. So if your IRA invests in a property, you are never allowed to stay in it. There are also people that are called disqualified persons that are not allowed to stay that. Disqualified person is you as the account holder, your spouse, your ancestors, your lineal descendants, spouses of lineal descendants, right? So ancestors, parents, grandparents, great-grandparents, lineal descendants, children, grandchildren, great-grandchildren, and their spouses, right? You and your spouse. Those are the disqualified persons. So your IRA can't buy a property from a disqualified person. So if you own a property, a rental property, and you decide, you know what, I'd rather have this in my IRA, can my IRA buy it from me? The answer is no, you're a disqualified person. right? If you marry someone and they have a property, can your IRA buy that property? No, right? Can your IRA lend to a disqualified person? No. So you can't borrow from your own IRA. You can borrow from a 401k. That's a different thing. $50,000 only. You have to pay it back in 5 years. That's 401ks only, right? But can you loan to yourself? Can you loan to a disqualified person? Can your IRA lend to a disqualified person? All those are no, right? Disqualified persons, you, your spouse, your ancestors, lineal descendants, and spouse of lineal descendants, okay? Note that it doesn't say siblings, aunts, uncles, cousins. It's not family members. A lot of people think that a disqualified person is a family member. It's not. It's very specific members of the family. Also, a beneficiary of your account would be a disqualified person. So if you name a sibling as a beneficiary, they become a disqualified person, okay? Everybody got that? Yeah. Can never, no. A disqualified person can never stay in the property ever. They can't rent it. They can't stay for free. That creates a prohibited transaction. And by the way, if you commit a prohibited transaction inside your retirement account, you are risking your entire retirement account becoming disqualified. What happens when it becomes disqualified? It gets distributed to you, the entire account. So penalties, taxes, all that stuff. If you commit a prohibited transaction, and I'll add the caveat, you get caught. So do we have people who have real estate inside their retirement account that they've got, you know, sons and daughters and people like that staying in it? Sure, I'm sure they do. But, you know, it's like cheating on your taxes as long as you get away with it, right? But it's a big risk because your entire retirement account becomes disqualified if it somehow comes out. And if so one time, as an example, and this was, I've been with Entrust for 7 years. The last job that I had before I got this one, business development manager, I was overseeing our compliance and internal audit. At one point, we got rent checks were coming in from the tenant for a property that was held by one of our account holders, and we noticed that they had the same last name, and it turned out it was their daughter, and we knew that because they named her as a beneficiary. We had to distribute that account to them. We had to. Right? We were legally obligated as the fiduciary on the account. We have no choice. If we get audited, and we get audited, we are subject to regulatory audits, and they pull that and they see that and discover that we didn't distribute that to them, now we're in trouble, right? So prohibited transactions, you can't stay in a property that's owned by your IRA. A disqualified person can't stay in that property. So you, your spouse, ancestors, lineal descendants. I know I didn't really, fiduciaries, plan service providers, if you have an accountant or a CPA or something like that, they're also considered a disqualified person. Qualified is everybody else, okay? If your IRA invests in a property, can you work on it? Can you paint it? Can you cut the grass? Can you repair it? Replace the roof if you're a contractor? What do you think? No, you may not. Disqualified person is not allowed to work on a property that's owned by your IRA, right? Can't paint it, can't do work on it. You have to contract that out. If your IRA owns a property, an investment property, and it needs work, you have to hire a non-disqualified, or you have to have a non-disqualified third party do it. You don't necessarily have to pay them. If your sibling, right, who's not a disqualified person, right, we already went over that, if they want to go and do whatever work that you needs done, you don't have to pay them, right? But it can't be done by a disqualified person. You can't do it, your spouse, your ancestors, your lineal descendants. Chris?
So does this pertain to physical work only, or does it also include managing?
All right, we're going to come back to that. This is physical labor that we're talking about here. You can't be swinging a hammer, right? Or wielding a paintbrush. Now, I'm going to come back to, because I had already mentioned as long as you don't get caught, right? I inevitably often get asked, how are they going to know, right? Like, how are they going to know I cut the grass, right? They probably wouldn't. The IRS probably wouldn't know that. But do you want an example where they could? Let's say your neighbor doesn't like you very much, and they know the rules about self-directed IRAs and know you used your IRA for it and saw you out cutting the grass. All of a sudden, they dime you out. I mean, it's not likely, but I mean, it's certainly a possibility. And now you've put your entire IRA at risk.
So but your neighbor, they looked up who owns the property next door, it would say IRA.
It says the Entrust Group for benefit of, or just shortened to FBO, the Entrust Group FBO your name and your Entrust account number. That is the entity that owns the property. That's correct. So whenever you use your IRA to make an investment, so Chris, who owns the investment in Topstone, right? So Topstone's a syndication. They have an LLC where they bring in different investors and they create a subscription agreement. That subscription agreement came to Entrust we have a form called a bidirectional letter that Chris completed and signed, instructing us saying, I want to send, $20,000 or whatever it was to Topstone. We have to review and sign that agreement, and on that agreement, the name of the investor is the Entrust Group, FBO, name and account number. Same thing with a property. If you're using your IRA to buy property, we have to review and sign all the documents, the contract. The title is held by the Entrust Group, FBO, your name and account number. It's not held by you as a person, right? The IRA is the entity that makes the investment. So yes, somebody could look that up and see that the IRA is on title. Okay? Direct or indirect furnishing of goods, services, or facilities between an IRA and a disqualified person is not allowed. The indirect is a tricky one. It's a conversation I have with realtors a lot of time. So realtors want to use their IRA to buy property. They want to be the agent on that purchase or that purchase. And if you go to our website, and we have a frequently asked questions document about real estate investing, we say, don't take a commission. I tell realtors, don't even be the agent of record on it. Have somebody else do it, because you're providing, in that case, a pretty direct, but also an indirect service, right? So you want to be really careful whenever you have your IRA invest in something to make sure, if you're a CPA, for example, providing accounting services, if your IRA decides that it's going to own 25% of some startup company and you're going to provide accounting services, if you're a CPA, that's a service. That's a service you're providing to the asset held inside the account. That could be construed as providing a service to the plan. So you just want to make sure that when you're using your IRA, it's for investment purposes only, and that you kind of stay away from it. All right. Are you required to have a property manager? So considering everything that I said, are you required to have a property manager if your IRA owns a property? Is it required? No, I heard. Anybody say yes? It is not a requirement. You are not required to have a property manager, right? So let's talk about what that means. Most property managers, they're going to find you tenants, they're going to, draw up the contract, and a lot of times they're going to receive the rent, right? You, as the owner of that property, or as your IRA owning that property, you can put ads on Craigslist, you can interview tenants, you can hire people, or you can, if you're going to have work done on it, you can meet with the contractor, show them the work that needs to be done. You can be responsible for your asset. So from that standpoint, you can property manage, you can manage your property. What you're not allowed to do is you're not allowed to touch the money, right? So if the IRA owns a property and it's rented out, the rent checks have to go to the IRA. Now you physically can receive a check, right? Like if you want to have a tenant send the check to you so that you can log it, that's fine, but you just can't deposit it, right? It has to be made out to the Entrust Group, FBO, your name and account number, and sent to us. They can't make the check out to you, you deposit it, and then turn around to send the money to the IRA. That's prohibited, right? Any money that comes from you to the IRA is considered a contribution. And this isn't a contribution, it's return on investment, okay? So you can, again, you can oversee your asset, but you can't handle the money, right? You can't have an account for the money. And one sec. And the other thing is that to be really careful about, it's one thing if your IRA owns like a duplex or owns one property and it's something where once every year or two you have to interview tenants and put an ad up and blah, blah, blah. But if your IRA is an investor or owner in, let's say, a large building or a large complex, or it's a part owner, and all of a sudden it's become essentially a full-time job for you to take care and interview tenants and all that stuff, now you're crossing over the line where you should probably have a property manager do it. Right? Now, there isn't anything specific in the code, in the Internal Revenue Code, that says what becomes okay to property manage, what is not okay to property manage, right? There isn't any black and white with that. So I can't sit here and say, like, if you have this many doors, then you should have a property manager, right? It's not that black and white. But if it gets to where it's something you're doing like on a regular basis, as opposed to, you're taking a call every once in a while from your tenant versus it's for all intents and purposes, a full-time job, then you're crossing over from what you're doing something that's prohibited to what you're not. Okay, you had a question? Okay. All right, everybody clear on that? So income and expenses. Your IRA owns the property. Who receives the income? The IRA. Who pays the expenses? The IRA. Everything has to flow into and out of the IRA. Property taxes, insurance, maintenance, all that stuff has to be paid by the entity that owns the property, which is your retirement account. So bills come to us, we pay the bill, right? We do it at your instruction, but that's part of our role as the administrator of the account, is that we handle all these transactions, but we do it at your instruction, right? So we will, a lot of times, we'll get a property tax bill, will come into us. We turn around and forward it to the account holder and say, do you want us to pay this? Because we do everything in instruction, but it does have to be paid from the retirement account. If you paid it from your own checking account, you've created a prohibited transaction, right? You want to make sure that you handle everything, it funnels into and out of the retirement account. People ask, what if I need a new roof and I don't have enough money in my retirement account to pay for the roof? What do? You better get some money in that retirement account because the account has to pay for it. Now, there's a few different ways, and I'm going to come back to that a little bit. So can you sell, transfer property that you own to your IRA? I think I already told you the answer to that. No. So that's considered self-dealing and is a prohibited transaction, right? So your IRA has to buy a property from a non-disqualified third party. You can't simply transfer your own asset into the account. In order to get an asset into an account, you have to put cash in the account, and then the IRA has to use that cash to buy an asset, right? You can't just simply move an asset into an IRA. Now, 401ks, interestingly, are different in that you can actually contribute an asset into a 401k, but you can't to an IRA. Again, there's contribution limits. So if you think, well, I can put my property into a 401k, well, if your property is worth more than $55,000, then you can't put the property, you can put a portion of the property inside it, but you can't put the whole thing in.
Yeah, a related question. Let's say I'm in this situation where I'm in a tenancy and common ownership
Yeah.
of real estate, so it's 50%, 100%.
Yeah.
What if he sold me his 50%, I put it in IRA, and I would say to him, and we're not related parties?
Well,
Does that work?
so you're already a part owner on the property, so no, that wouldn't work. Because you're already a part owner on the property, so your IRA is disqualified because you're already, you're already, I mean, all right, so if you're talking about logistically, could you submit the paper to work to us that it would go through? Probably. Would it be prohibited if it got audited? Probably, right? So you'd have to become no longer on the property, right? So he would have to buy your 50%, he'd have to buy your 50% from you and then turn around and sell it to the IRA, right? And then, or sell 100% to your IRA and then you turn around and sell 50% back to his IRA or however you want to do it. So logistically, could you pull it off? Yes. But you would be, working your way around the rules in the IRS if they got a hold of that. But if you submit the documents to us that showed that your IRA was buying from him, and you weren't, and we knew you weren't on it, then we would process the transaction because that on its face is not a prohibited transaction. What you did prior to get the property in the right hand so that you could pull that off, that's up to you, right? And the risk that you're taking that eventually that would be looked at as prohibited, right? Always, yeah. And I go back to that first thing that says I'm not a CPA. All this stuff we suggest have advisors, talk to CPAs, all that stuff, right? Yeah. They do not. Yep. Well, yeah, and if you didn't hear, the comment/question was, no, a lot of CPAs know about self-directed IRAs, and to a large extent that's true. But I mean, we can point you to the code that mostly, it's section 4975 of the Internal Revenue Code that talks about prohibited transactions as a disqualified person. Any CPA should have the ability to take 15 minutes to read that section of the code and be able to figure it out. I have one person actually I had a guy who had me come in and do a podcast, and he knew a lot about self-directed IRAs. He's since retired, but he passed on the business to a woman who, a young woman, she's out of San Jose. She's the only one that, like, when people say, do you know a CPA? I've got one. I got one that I refer people to, but she does. Yeah, she's got an understanding about it. Yep, but again, like any CPA, if a CPA doesn't know about it, I could have a 15-minute conversation with them, and by the end, I would feel confident that they're smart enough that they would know what they need to know, right? They'd ask the right questions, and it wouldn't take a long time to get the part that they need to understand, right? Because ultimately, they're going to know retirement accounts, right? They might not understand all the rules specifically around self-direction and real estate and what's prohibited and stuff like that, but it wouldn't take that long to explain it. Okay. Can your IRA borrow to invest in real estate? So you have, $100,000 in your retirement account. You want to buy a property for $150,000. Can your IRA borrow to get that other $50,000? Anybody have any thoughts? Yes, no? What do you think? Yes, it would be hard to find a loan is actually probably a pretty good answer. So the answer is yes. The IRA is allowed to borrow money, but it is required to be what's called a non-recourse loan. That means that the IRA, again, I mentioned, who goes on title, the entity that's buying a property is the Entrust Group, FBO, your name and account number. The entity that's borrowing the money is the Entrust Group, FBO, your name and account number. So the IRA borrows the money. There are financial institutions that are willing to do non-recourse loans to an IRA. It's required to be non-recourse. What that means is that if you were to default, if your IRA were to default, the only recourse that the lender has is to foreclose on the property. They can't go after you personally. So you can't have any personal guarantees in the loan documents, and you can't use anything else as collateral, and they can't go after anything else in your IRA. They can't go after the cash in it. They can only foreclose on the property, right? It has to be a non-recourse loan. We have a list of lenders who are willing to do non-recourse loans to IRAs. 3 banks, 2 private money lenders. That's our list, right? If you wanted to have your IRA borrow money, I mean, you could feel free to find, you can have a relationship with a bank. Like, it's not that you have to use our list. It's just that these are lenders that we know are willing to do non-recourse loans to IRAs. The loan-to-value ratio is going to be more strict. They're going to be looking more like 30, 40% down as opposed to 20% whenever you're doing a personal loan, all right? But the IRA is allowed to borrow money. So I want to go back to my one comment that I was making before that I was getting ahead of myself a little bit. If you have a property and you have some work that needs to be done, you need to replace the roof, and you don't have enough money in your retirement account to cover that fee, your IRA still has to pay for that cost, which means you need to get money in the retirement account. You make a contribution, or you transfer or roll over more money from an existing IRA or 401k that you have with another custodian, or your IRA can borrow money. Not only are there financial institutions, your IRA can borrow from any non-disqualified third party. If you need $10,000, you don't have to go to a bank if you have a sibling or a friend or somebody who's willing to loan $10,000 to your retirement account. You just have to draw up a loan document, and the loan has to be non-recourse. And the loan is to the IRA, and Entrust signs the loan document. The money comes into the retirement account, and then you instruct us what to do with that money once it gets inside the account, right? It's your asset, right? It's your retirement account, it's your asset. You are allowed to make all these decisions for yourself. We can help facilitate it, and we'll make sure that you're legal and compliant in terms of doing it in the name of the IRA, as long as you're running the documents by us. If you do your own side deal and we don't see it, you're putting your IRA at risk, but to do it legally, you have to do it through your IRA.
How can I want to use some of my money for my self-directed IRA, and I don't have enough to buy it?
Right.
How do I make that work? Can I make that work? Can I bring the self-direct, the hard money lender and move the IRA back out?
There's ways to make that work. Yeah. I mean, we'd have to. I mean, are you talking about your IRA borrowing the money or partnering with other people? All that. It can be done. You would just have to figure out how you want to structure it, and we'll help you figure it out. Or at least I would help you figure it out. Yeah, it shouldn't really take any longer. I mean, we will process the stuff from 1 to 2 days from the day we receive the documents, right? So the holdup's not going to be on our end, right? In terms of how having that, as long as the money's in your account, as long as you have to fund your account, and a lot of times it might take a week or two to transfer a rollover from your other custodian, right? So that has to be factored in if you don't already have money in the account. So like some of that stuff, but that's not, as far as you get us the documents, we'll tell you what documents we need in order to process your investment. As long as you get the documents to us, we'll process the investment. Well, we don't, I mean, we will work with you and whoever else you need to bring involved, attorneys or realtors or mortgage companies, and tell you what we need. We'll tell everybody what we need to make it happen, right? But we're not, I mean, that's what you tell us what you're wanting to do, and we'll tell you what we need, what documents we'll need to make that happen. Yeah. Yeah, and that's, I mean, those are transactions that people do all the time. Again, I mean, your IRA can lend money too, right? So one of the, like all the stuff we're talking about, which is very real estate focused, but again, like your IRA is allowed to process any type of investment transaction that's allowed. So one of those could be your IRA could be the hard money lender, right? You could find borrowers, like if you're in that field and you've got some kind of deal that somebody's looking to borrow money and they need it quick and they don't want to go through a bank, you can lend from your IRA. You draw up a promissory note, the borrower signs a note, the IRA is the lender, you tell us to send the money to the borrower pays the IRA back. That's allowed, right? That's an investment. That's an asset that you're allowed to hold inside your retirement account, a prom note. Yeah. It can't, yeah. Can an IRA borrow from an entity like a trust or an LLC? Sure, as long as the beneficiary of the trust isn't a disqualified person, right? As long as you're not the beneficiary of the trust or your spouse, right? Or the LLC isn't owned by you, right? Like an LLC that's owned by you or your spouse is still considered a disqualified person. But an LLC that's owned by a sibling or somebody like or a friend or anybody that's a non-disqualified third party, sure. Can borrow from anybody that's not a disqualified person. You shouldn't do an interest rate. Can the interest rate be anything? Can you do an interest-free loan? You shouldn't. Actually, we wouldn't process an interest-free loan. It's got to have something. Yeah, there's got to be some interest on there. Which, we talked about the Kiva. I was sitting there like thinking, people could use, was that yeah. I mean, in theory, people could do that, but that's really more of a charity thing. I don't know if you could do that in an IRA because that's more just giving the money away. That's a charity. So the IRA is the borrower on the loan. The loan documents are signed by interest on behalf of the IRA owner, the IRA holder. Even IRA owner is a misnomer because you don't own your IRA. You're the beneficiary of the IRA. I should change that. Okay, does that make sense? Can your IRA partner with others on an investment? So let's say there's a property out there for a couple $100,000. You have $100,000 in your IRA and let's go spouse. Your spouse has an IRA and they want to also use $100,000 from their IRA. Can you partner those two together to buy that property? You absolutely can, as long as you do it at initial investment. So when we talked about the disqualified persons thing and prohibited transaction, your IRA can't buy from or sell to a disqualified person. Once your IRA owns a property, a disqualified person goes into effect. But on a new investment, you can partner your IRA with anybody. You can partner with yourself. You can partner with your spouse. You can partner with other IRAs. I have 2 properties in my IRA. One I partnered with myself. One I partnered with my health savings account. So each account owns a certain percentage. So on title for the one property that I have, which by the way, just to let you know, it was originally a note where I held a deed of trust on the property and they defaulted on the note and I foreclosed on the property and that's how I ended up with it. But it's 88% owned by my IRA, 12% owned by me. So on title on that property, it shows the Entrust Group, FBO, Bill Neville, William Neville, account number, 88%, and then William Neville, 12%, and some change, right? So it's allowed, which means for revenue that's generated, the rental income goes to 88% to the IRA, 12% to me. Any expenses are paid 88% by the IRA, 12% by me. So just to add on to that a little bit, the way I do both of my properties since I partnered is that I have a property manager because they're out of state. So I asked my property manager, can I just have the tenant send you the checks and you keep an account for me? And then whenever I get a bill or need any maintenance, you just pay it from the account. And then once a year or so, I'll have you send some money to my retirement account. It's actually been a couple years since I haven't sent any money. I can do that because the property manager is a non-disqualified third party. I'm not holding the money. So the money doesn't necessarily have to pay directly into your IRA. It just eventually has to flow to the IRA. It can't be held by me, right? Or my spouse that I don't have, or parents or children, right? That I don't have because they're all disqualified persons, right? But it can be held by a property manager. So that's how I choose to do it, is I have a property manager who receives the rent and I have a property manager who pays the bills, and then every once in a while I have them send money to my retirement account. Okay, does that make sense?
Is there a minimum percentage ratio?
No. Mm-mm. 91-1, sure. Absolutely. You can do, and again, but the key is if you're going to partner with, you can partner. So, and I talk about partnering with what would typically be a disqualified person at initial investment. You can partner with anyone at any time, right? That's a non-disqualified third party. So in your example, when you were talking about the TIC, so I'm assuming it's not a spouse or anything like that, right? So if you own 100% of your IRA owns 100% of the property and you want to sell 50% to that other third party, you're allowed to do that. You can sell off a part of your asset to a non-disqualified third party. But if you want to have a partner be with what would typically be a disqualified person, so spouse, parent, or their IRAs, then you have to do it at the time that you structure the investment. Because once that investment gets structured, now those percentages are fixed, right? If it's 50-50, you can't all of a sudden decide you're going to go 60-40. Unless it's, again, it's a non-disqualified third party, then you can change percentages all you want because they're not a disqualified person. Right? Did I make that confusing? No? Okay. All right. Last question. And I'm not going to ask you to answer this. So, Singlemember LLC. So if you find yourself researching self-directed IRAs and you come across the term checkbook IRA or checkbook control in your IRA, this is what they're talking about. They're talking about setting up a single-member LLC where instead of your IRA investing in a property, your IRA can then become the owner / member of the LLC, and then the LLC becomes the entity that invests in the property. So it's still IRA money, but you use the LLC as a pass-through entity, and the big advantage is it gives you checkbook control. So everything that I've been talking about here, it's been under the assumption that your IRA is going to invest directly. So you send the documents to us, we review the documents, and then, and if it's a property, title is held under the name of the IRA. But if you want to have checkbook control, if you want to be able to write your own checks, then you can create an LLC where your IRA becomes the member of the LLC. You can be the manager of that LLC as long as you're not paid for it or taking any kind of expense reimbursement, right? But you can manage your LLC. You open a bank account in the name of the LLC. You instruct us to invest in that LLC. So the entity, the asset that's held inside your retirement account is the LLC. But it's, and then the money gets put in the bank account that you've opened in the name of the LLC. Now you can go make investments in the name of the LLC. You can buy a property in the name of the LLC. You can buy a racehorse in the name of the LLC, which means the rent checks get paid to the LLC. The bills get paid from the LLC. That becomes a pass-through entity that allows the money to flow in and out. Eventually, before you take money as a distribution, it has to get paid back to the IRA. You can't take money directly from the LLC, but it gives you checkbook control. So, again, if you ever hear checkbook IRA, there is no company that's you're going to open an IRA, they're going to hand you checks. You have to do it through an LLC. Now, we focused on single member LLCs, but you can partner in your LLC. And an LLC is oftentimes an ideal way if you're looking to partner your IRA with other investors, particularly if it's more than one other investor, because you don't want to have a tenant making checks out to 3 different people, right? Or 2 different people, or 4 different people. That's one of the reasons why I use the property manager the way I do, because I don't want my tenant making 1 check to me and 1 check to my IRA. I want them just making 1 check to the property manager. So the LLC gives that equivalent sort of ability to do that. They would make 1 check to the LLC, then the LLC can pay your IRA and you and whoever else is invested in it.
So, let's say you're about to acquire a new property. You can just do it immediately through this LLC versus
That's correct. Once the IRA invests in the LLC, all investments are done in the name of the LLC. We're no longer involved in reviewing any documents, signing any documents, because the IRA is not going to be the entity on title. The LLC is going to be the entity on title, and you're assuming you're the manager of that LLC, then you sign as manager of the LLC on all the documents.
How long is the review process? So let's say the real estate.
Couple days, 1 to 2 days, yeah. Well, yeah, I mean, there's a lot of, like anytime you're closing on real estate, like that's why there's like always 30-day closes and stuff like that. There's a number of documents. So any individual document that comes to us, it's usually 1 to 2 days to turn it around, right? But then there's more documents that have to come, and then there's 1 to 2 days on that, right? But like the contract has to come first and we sign it. And then there's a warranty deed, and there's just various documents that have to come into us and each time you have to allow for 1 to 2 days for us to, because we're always getting real estate transactions come in, they just go in the queue, right? And then they get reviewed when they get reviewed. We have a real estate group who does it. Yeah. No, that would be a prohibited transaction. For investment purposes only. The IRA the LLC is a pass-through entity that gives you checkbook control to make investments and pay for things that are held by that investment and receive rental income. But no, you make a check to yourself, you commit a prohibited transaction, right? You're a disqualified person. You could partner yes, and then so you would make a check out to yourself for your percentage of the LLC, sure. So if you do a 50-50 ownership in the LLC, then you're receiving rent and you're going to pay 50% to you and 50% to the IRA, then yeah, you're going to be writing checks to yourself for sure.
And does that mean that the LLC is then responsible for higher payments?
Well, you're always that's responsible for paying it, right? I mean, you as the person who's owning that property or your IRA, like we're not going to hire the maintenance people. So either have a property manager or do it yourself. But whether you have an LLC or not, that's going to be your own responsibility, right? So the process, these are wrong. Open an interest account, 10 minutes. We have a portal online that you can do it, and you'll get it open in 10 minutes. Fund your account, transfer typically takes about a week, 5 to 7 business days. Then to purchase your asset, we say 2 to 3 days. Chris, what's your experience with us?
First, let's get to another thing that's a little bit more of a basic level. I think a lot of people in here have a retirement account, and they're here, so they're interested in probably moving it into a self-directed account. Could you cover under what circumstances they can
transfer
their current account into and trust
Yeah.
self-directed?
Yeah, no, that's a good point.
Because I think that's one of the main reasons why most people came out here, because they're interested in doing that. And could you talk a little bit about when people are eligible to do that and when there aren't?
Yeah, no, that's a good point. So most people fund their account. There's 3 ways to fund your account. Make an annual contribution, transfer from a like account or usually an existing IRA, or roll over from a 401k. Qualified plan. So there's a difference between a transfer and a rollover in terms of how it's processed. So when it goes from an IRA to an IRA, it's a transfer. And the way that's done is you fill out our transfer form, we send it to the other custodian to effect the transfer. It's called a trustee-to-trustee transfer, and you can do that anytime you want, right? If you have an IRA, you can transfer to an IRA with the custodian anytime you want. A 401k to an IRA is a rollover. You have to contact your 401k provider to initiate the rollover, which is technically a distribution to you that you have 60 days to roll it over, okay? If you have a direct rollover where they send the money directly to us, it's still a distribution, but you don't have to worry about the 60 days because they send it directly to us, right? So you can do an IRA to IRA transfer anytime you want, as many times as you want, to as many different custodians as you want. 401k to IRA rollovers, if you work for the company, if you currently are covered by that plan, then it's unlikely you're going to be able to roll over that company unless you have a triggering event. A typical triggering event, you leave the company. Okay, that's the most typical scenario. If you have an old 401k with a company that you work for, you can roll that over to an IRA if you want to, and then self-direct it into whatever you want. If you have a 401k with a company that you currently work for, you would have to talk to your company or the plan provider and ask them if you're eligible to roll that over into an IRA. Okay, does that make sense? As long as you do the rollover within 60 days, right? So there's no tax consequences as long as you do the. So what happens with the rollover is the custodian that you have the 401k is going to process as a distribution and report that to the IRS and to you as a distribution. You roll it over to us, we're going to send a Form 5498 to report to the IRS that you rolled it over to us. You just have to make sure that you either have them send it directly to your IRA with us, or if they send it to you, make sure you forward the money on. You can deposit it. You can hold that money for 59 days if you want. But if you want to avoid the tax, get it to us by the 60th day. And the countdown starts, by the way, from the time you receive the money, not the time that it was sent out. Okay? So you can put 401ks, IRAs, SEP, traditional, all into one account, right? Like a SEP to a traditional, simple to a traditional, traditional to traditional, 401k to a traditional, 401k to SEP. Those are all, because they're all pre-tax that grows tax deferred. You can put those all in one account. If you have a Roth, then that has to go in its own account, right? But Roths, and you can partner multiple IRAs into one investment, right? You can partner your Roth and your traditional. I partner, like I said, on one of my properties, I partnered my IRA with my health savings account.
So you can just merge, like I have like a simple IRA, self-directed IRA, and the regular one.
Traditional. Sure, because they're both pre-tax. The difference between a simple and a traditional has to do with contribution limits, right? So, I mean, if you want a simple for the contribution limits that you have, then keep having a simple, but you can put those, they're both pre-tax, so you can put those into whatever, type of IRA you want to have with a company like Entrust.
Yeah, but is there any benefit to having multiple accounts? Because we're not you, but so I don't want to. I mean, isn't there like having several accounts because
All right. Is there an advantage? I mean, the advantage to having accounts with multiple custodians is if you want to invest in assets that the one custodian doesn't hold, right? I mean, that's the main reason why people transfer money to Entrust is because Fidelity or whoever won't invest in real estate, right? So, but they still want to have some money in stocks, bonds, mutual funds, and Entrust isn't a dealer broker, and we don't hold stocks, bonds, mutual funds. So you would need two separate accounts to cover those two separate asset classes. Unrelated business, that's not about the account. No, it's about the investment that you hold. So, all right, UBIT. I can bring up UBIT. So, it's called unrelated business income tax, or you might also hear as unrelated debt financed income tax. If your IRA, if your retirement account is running a business, so not investing in a business, but if it's actually owning a, like let's say you decide that you're gonna, we had somebody who, or I know of someone who purchased a franchise and they held it inside their retirement account. So that account owned a business. It was paying the employees, it was receiving the rent, it owned a business, it was running a business. It's subject to what's called unrelated business income tax because it owned a business. It's not just investment, okay? So that account did have to pay tax, right? Then there's also, I had mentioned that your IRA can borrow money. If your IRA borrows money, it's also subject to UBIT, or the other side of the coin, it's the same thing, but you hear it as unrelated debt finance income tax. So what that means is that, to give you an example, let's say your IRA borrows 50% of the investment that it's going to make. So the IRA owns 100%, but 50% of that is borrowed money. And then your IRA makes net, so after expenses, it earns $10,000 in net income at the end of the year. 50% of that $10,000 is subject to a tax, right, called unrelated business income tax, all right, because it used non-IRA money, right, because 50% of the money came from a bank, so it's not IRA money. So the IRS looks at that and says, well, 50% of the earnings didn't come from your IRA money. It came from this loan that you borrowed. It's not pre-tax money, so you have to pay taxes on it. UBIT is at trust tax rate. It's a different tax rate than what our income tax is, but it's not dramatically different. It's the same thing. It starts at like 12% on the first certain dollar amount, and it goes up from there. Okay, so, but that has to do with your investment. It has nothing to do with your type of retirement account or the multiple different. Another reason potentially to have multiple retirement accounts, which I was doing a presentation one time and somebody made this comment, because I talked about prohibited transactions, disqualified person. Let's say you're going to do an investment inside your retirement account that falls into the gray area where you think you might be crossing the line behind doing a prohibited transaction. you might want to keep that asset in its own retirement account, because if it does get audited and it's determined that there was a prohibited transaction, that retirement account becomes disqualified. And if you have other assets in there, your entire retirement account becomes disqualified, but you have it in its own account, then only that one asset becomes disqualified. So for a reason way to do it, that might be one of it.
Well, yeah, I think my CPA said something different. He said that that the IRS gives you a freebie if you have $1,000.
Yeah, you get a free $1,000 on you, but yeah.
That's why he said that if you have multiple accounts, you get that freebie per account.
That's a good point. Yeah,
So,
that's a valid point. Sure, I hadn't really thought about that.
have to file IRS paperwork and all that.
Yeah, there's a form that you have to report for the UBIT. Yeah, but that's a valid point. Sure, if you're using borrowed money, or now again, investing in a business is not subject to UBIT, right? Owning a business is subject to UBIT, and then borrowing money is subject to UBIT. Yeah, if you're using, but it's a valid point. Yeah, because the first $1,000 they don't. If your earned income, the net income for your investment is under $1,000, then you don't have to pay any taxes on that. So yeah, if you have multiple different assets that you're using borrowed money for, then that's a valid point. That makes sense. I hadn't really thought about that.
Is there a practical limit to the number of accounts you can have?
No.
So if you get 1,000 free per account, 1,000 accounts, $1 million freebie.
Yeah, I mean, well, that would be, I mean, the assets themselves wouldn't be, like, you're not talking about $1,000, $1,000 investments, right? They're probably $100,000 investment that you might be earning $1,000 or $20,000 investment. But I mean, in theory, yeah, I mean, in theory, you can have as many different retirement accounts as you want, right? From my standpoint, how I get paid is I earn money. I get commission on opening accounts. So I would encourage you to open as many retirement accounts as you want. I'm going to start selling the idea of it, to be honest with you. So that's it. I mean, that's a really kind of basics overview of self-directed IRAs. Again, the big thing to take away from this, that I would want you to take away from it, is that you're allowed to invest in pretty much anything you want inside your retirement account. You're not limited to just stocks, bonds, mutual funds. If you can imagine it, then you're allowed to invest in it. So, you know, if you're looking at different types of investments, or something's intriguing to you as a potential investment opportunity, you're allowed to do it inside your retirement account. So if it's something you want to do, then, you know, that's where we come in. We'll help you. We'll provide the administrative services for that. If the IRS allows it, then we're willing to hold it, right? And so, like the Singlemember LLC, there's a lot of companies in our space who aren't willing to do that. They don't like that as an asset. We don't have any problem with it. The cannabis industry, we're getting people who are expressing more and more interest in investing in cannabis companies. There are companies in our space who are not willing to hold that because the federal rules on that are still iffy. But if you as an investor want to take that risk that something federal might impact your loan or your investment, who are we to say that you shouldn't do it? We'll hold that investment. Cryptocurrency is becoming a very popular investment inside self-directed IRAs. I went from 2016, where I got maybe a handful of calls on cryptocurrency investing, and can you do it inside a retirement account, and how does it work, to I got one practically every day all of last year. Slow down. I'm not getting as many so far this year, but 2017 was nuts. Now, cryptocurrency would need an LLC, right? So that's one of those things where we talked about the Singlemember LLC, then you have checkbook control. You would open an account with the cryptocurrency dealer in the name of the LLC. Then the issue with that is that cold storage wallet that you have to hold, right? It can't be, we don't have the ability to hold that wallet, and you can't physically, or you can't personally hold it, but the LLC becomes the entity that gives you the ability to hold that wallet. So, but anyway, those are just, again, I'm not suggesting that you should invest in any of those things. I'm just throwing out some things that people have invested in. Yeah, Tasha. Yeah. Yeah, we don't. No, I understand the question. We don't facilitate that. Like, that's not, again, that's not a role that we play. We're not. We do, so we are doing a new thing where we're creating a marketplace of investment opportunities for our existing clients to be able, so Topstone, for example, is going to be on our marketplace that of referral partners, referred clients that can go, and if they're bringing cash in or they've cashed out and they want to put it in something else, they don't want to know where to invest, they can look at that marketplace. That's a new thing for us. We've always steered very far away from coming across as endorsing or promoting anything. And we're starting to warm up to the idea of at least offering opportunities, which would just be referral partners. But in terms of like hooking like people who want real estate with like IRA owners who you know might want to lend money, or like people who sell real estate with our IRA accounts and like bringing those together, it's not a role that we play. We don't do that. I don't know that anybody in our industry does, to be honest with you. I mean, I could probably do something. I mean, I've thought about it, doing something local or something, and you know, I've thought about doing something like that, but I'm not sure I want to or not. It's a role that we don't. It's just not what we're just administrators of the self-directed IRA. The self-directed means that our account holders make all their own investment decisions without any input from us. Okay. Yeah.
Yeah, so let's say I buy real estate and I don't do the check card IRA thing.
Yeah.
Well, logistically, how does it work? I mean, let's say I've got an electric bill to pay.
Yeah.
And
You can log into your account and go to pay the invoice and then upload the bill to us, or you can fill out. We have a payment authorization form that you would fill out PDF and fax it or email it to us, and along with the invoice. But yeah, we have to see the invoice and then we pay it. So basically, you instruct us to pay it. You can either do it through our portal, or you can send us a form that we have, payment authorization form. Yeah.
About the same on utilities. Utility companies usually accept a FBO, they trust FBO name, account number as, you know, somebody that they're going to issue electricity to.
Yeah, that's a good question. I mean, honestly, I don't. Once it gets to that point where they're actually owning the property and setting up the utility bill and stuff like that, I don't tend to be involved. That's a really good question. It's okay if the utility bill is set up in the name of like if you as an individual need to set it up in your personal name, that's fine. Just send us the bill when it needs to be paid, right? Or have it come to us to be paid. Like, it's not so much who it's set up under, it's who's paying it. Yeah. It's a good question though. I mean, mine's the property, like for my two properties, it's the property manager that sets it up and pays it, or actually the tenant. I think the majority of the time utilities are just paid by tenants. So, but it's a good question. I actually don't know the answer to that. But like I said, it really doesn't matter. It's just who's paying that bill. Yeah, it can't be you paying it. Yeah. Make money? Yeah. Thousands and thousands of dollars. Yeah, it's really, really expensive. We charge a transaction fee to when you purchase an asset. If it's an LLC or non-real estate, we charge a fee of $95. If it's real estate, it's $175. That's a one-time transaction fee. And then we have an annual fee, annual record-keeping fee. We have two fee options, either a flat fee based on the number of assets or a fee based on the value of the account. The per asset fee is $299 a year. So you could have a property worth $100,000 or $1 million. It's one property, it's $299 a year. If it's a lower dollar amount, if you're only like, say, you're only investing like $20,000 in like cryptocurrency or something, we have a fee based on the value of the account that's a minimum of $199. Yeah. Right. Right. We charge $10 every time we cut a check. $10. Yeah. But I mean, if you ever looked at how much mutual funds are charging you for the commission that they charge, you would know that in our industry, not just us, in our industry in general, our fees are a fraction of what Fidelity and Charles Schwab and those companies charge. It's a fraction. But yeah, we gotta make a little bit of money. And then we make a little money on the undirected cash. So we have, in our accounts, we have a certain amount of cash, like particularly for real estate, people keep some cash. So we take that and we take about 90% of our cash, we have about $270 million, and we put it into CDs, that like 1, 2, 3, 4, 5 year CDs. And then we get 1, 2, we're starting to get like 3% interest. But between those two, the fees and the cash, the undirected cash that goes in CDs. And by the way, it's only in CDs. All of our cash is fully FDIC insured. But in our industry, that's not just Entrust. That's how the industry works. We charge some fees. We make some money on the undirected cash. If interest rates keep going up, like we're one of the few industries that want interest rates to go up because we make more money as a company then. Yeah. The fees that we charge? It's a great question. In 2017, they were. I don't know about 2018. My understanding is with the new tax laws, they're no longer tax deductible, but they were prior. Anything else? Yeah.
Bill, you're saying that I can't use self-directed to renovate a house where I live?
No.
No, I can't.
No.
You know other ways to do it?
Do I know what?
Other ways to do it?
Other ways? Borrow money. Yeah. It can't be your IRA. Somebody else, I mean, if you have like a sibling who wants to use their IRA to help you renovate your house and figure out a way, like, I don't know, a note or something like that, or give them part ownership of your property or equity or something like that, that's a way to do it. It just can't be your IRA, right? Because it's your house, you're a disqualified person. But it could be a non-disqualified. If you want to work out something with somebody in your life who's not a disqualified person to give them, equity based on the increase in value of the property or something like that, yeah, you can do something like that. Just, again, it can't be your IRA, yeah. Are the account, yeah, good question. Yeah, account fees paid by the IRA or by you as an individual, either whichever one you want. They can be debited from the account or you can pay them from outside the account. Like I said, it used to be when you paid them outside the account, you could deduct it on your taxes, but I don't think that you can under the new tax law, but that would be a question for a CPA. Okay, yeah.
So in theory, I could come up with some convoluted financial agreement, let's say an option to buy real estate or something that I negotiate with somebody.
People have done that.
And that is fine. You're just going to be looking for like help with the title and stuff.
And making sure that it's not a disqualified person that the option is being bought from or sold to, yeah. Yeah. Oh, we've had people make a lot of money through real estate, through an option to buy, and then there have been a couple times where like I looked at and said this could possibly be legal, but I mean there was nothing obviously prohibited, so it's the IRS to deal with after that. Okay, I really do appreciate everybody coming. I know it's not the most exciting topic in the world, but I'm glad everybody came. Thanks.
Let's hear it for Bill. Okay, so a quick recap and a couple of notes of my own. So basically, if you have a retirement fund for a company that you don't work with anymore, it's not a lot of hassle to transfer it over into self-directed, either as a transfer or a rollover. Also, you can do a lot of creative stuff. As to your question, you can do stuff where like your brother lends to you for your rehab and you lend to your brother for some other reason. I actually know I actually personally know okay, Bill, close your eyes because a better one is coming up. I know an ex-husband and wife who decided that they were better business partners than marital partners, but they're still business partners and they're just rehabbing up a storm. They do fix and flips. What they do is the ex-husband says to the ex-wife, hey, do you want me to do this property in my IRA? And do you want to do that property in your IRA? So they do these properties in each other's IRAs, where basically, it's the same deal as what I'm saying with your brother and you passing him back a note. Then there's also people that I know that do wholesaling within an IRA or even a Roth IRA. And that gets really interesting because when you enter into an option to buy a property, right, when you're wholesaling, you put down, it can be a $10 or $100 option fee. But when you actually wholesale the property, that can be, I think Ryder just did one for 20 grand recently. So that would be 20 grand tax-free, and particularly when it comes to a Roth IRA, because the problem with a Roth IRA is they're awesome. However, you can hardly contribute any money into those things. You can only contribute a very small amount. I even stopped. I have a Roth there. It's actually like with Bill too now. Yeah, it's ridiculously small. It'll never get you anywhere unless you say, I'm going to take $100 off of that. I'm going to use that as my option fee, and then my Roth IRA is going to wholesale the deal. That basically means you get 20 grand tax-free, not tax-deferred. So that is pretty powerful stuff. Bill says this is boring. I actually think we're kind of trained to think this is boring, but I think in reality this is pretty fascinating stuff, because even though we might not be able to get to that money right now to buy a Lamborghini for ourselves, it is our money. Right? And it should interest you just as much as your regular money interests you. anyway, those were kind of like my recap and my final thoughts and things that I wanted to add on to there. So thanks again, Bill Neville.